Thanks for watching this Magellan in Review infrastructure update. We hope that all advisors and stockbrokers, investors and shareholders are staying safe during this ongoing global pandemic. Today I'm speaking with Gerald Stack, the head of infrastructure at Magellan. Gerald, in the past, the infrastructure sleeve, as distinct from utilities, of the portfolio has delivered some really solid returns. But given the portfolio has reduced its infrastructure exposure from around 55% to 43% over the last 12 months, should investors in the fund expect a lower return profile?
Good morning, Frank. Look, no, the infrastructure as we define it, we believe should deliver investment returns of inflation plus approximately 5%. And we see no reason for that to change. At any given point in time, our allocation in the portfolio to utilities and infrastructure, which is sort of the two major components, is going to change. If I was to go back a decade ago, our portfolio was roughly 60% utilities and 30% infrastructure. And over the last 5 years, we've had a heavier weighting to infrastructure than utilities. And just at the moment, we have a heavier weighting to utilities and infrastructure. But we see no reason why utilities as a separate sleeve or infrastructure as a separate sleeve won't deliver to that inflation plus 5%. We get very different things out of, or very different return structure out of the different components of the portfolio. So if we think about utilities first, utilities are generally regulated at the point of earnings. That is, a regulator allows a utility, water, gas or electricity to set a price for the delivery of their service that enables them to earn, inverted commas, a sort of a fair return. And a fair return is sort of 8 to 9% around the world. And that's the way that utilities are regulated. Now, as a result of the COVID-19 crisis, we've seen little or no impact on utilities in their immediate earnings outlook and indeed in their long-term outlook. If we look at reporting from utilities over the first 6 months of this year, basically the utilities that we are in our portfolio and generally the ones that we're focused on have reaffirmed their earnings guidance for this year. There may be some losses due to bad debts and so on, but they've essentially reaffirmed their earnings guidance for this year, and they've reaffirmed their longer term earnings guidance over for the next 5 years or so. So their earnings largely unaffected, notwithstanding that prices are down. As in, if I look through the first 6 months of this year, our assessment, our analysis tells us that the average price for regulated utilities is down about 8%. So earnings largely unaffected, prices down. That looks, relatively attractive to us. So our weighting to regulated utilities has gone up through the period, and they dominate our portfolio relative to infrastructure at the current time. On the flip side, infrastructure, it tends to face either a regulated price or a long-term contracted price, rather than a regulated earnings or long-term contracted earnings. And therefore, given that it's price that's regulated or contracted rather than earnings, volumes are important. The volume of passengers through an airport, traffic through a road, containers across a railroad, or data through a communications network. And clearly for transport infrastructure, in particular for toll roads, airports, railroads, the quarantining mandated by governments has meant that there's a lockout of physical commerce. There's been a significant reduction in the first 6 months of the year in those volumes. And therefore, and in addition to which, there's some uncertainty over the medium term about the way that those volumes recover. So utilities offer about 8%. Infrastructure is, on our analysis, off about 10 to 11% in the first 6 months of this year, but facing a much more uncertain outlook. So we've elected to reduce our allocation to infrastructure at this point in time and to really focus on those assets where we're most confident about the earnings outlook. Doesn't mean that we won't go back to some of those infrastructure companies in time, but just at the moment we're focused on those things where we're very confident about earnings. So a higher weighting to utilities, a lower weighting to infrastructure at the end of June compared to where we were 6 months or a year ago. But there's no reason to believe that we won't continue to deliver inflation plus 5 over the medium term. We remain confident that if we get the definition right and we find those assets that deliver the appropriate earnings profile, that there's no reason that we won't deliver returns consistent with our expectation.
And so what do lower for longer interest rates mean for infrastructure assets? Is it actually good or bad?
Well, I think you've got to think about this from two perspectives: the impact upon the business and then the impact upon valuation. So again, if we break our world up into infrastructure and utilities, if I think about utilities first, as I've touched on already, utilities are regulated at the point of earnings, and therefore lower interest rates, to the extent that they mean lower costs, will also end up meaning that when you go back to the regulator, all things being equal, you would reduce the price of your service such that you continue to earn a fair return. So in other words, your fundamental earnings really are unchanged. Lower interest rates are broadly supportive for valuations in that a lower interest rate is going to mean a lower cost of capital, a lower rate at which we discount future cash flows, and therefore earnings broadly maintained. Lower discount rate, again, all things being equal, means that lower interest rates should be, broadly speaking, supportive, we would think, for regulated utilities. For infrastructure, lower interest rates are going to be reflecting the fact that there's lower inflation and probably lower growth in the economy, and as a consequence, you're probably going to get lower volumes, lower patronage volumes. You're also going to face lower costs. You'll have lower inflation escalation of your prices. So again, all things being equal, we think the overall impact of that is relatively immaterial to the path we see for fundamental earnings for the majority of infrastructure companies that we look at. Clearly, if there's a significant short-term shock, such as there has been for airports, then that's something you need to take into account. But over the medium term, we would expect the fundamentals to be relatively well preserved. Again, lower rates are going to be broadly supportive for valuations. So we think, in general, lower rates should be broadly supportive for infrastructure over the medium to longer term.
And so, Gerald, the whole COVID-19 impact and lockdown has changed the way a lot of us work, the way we socialise, some of our consumer habits. Are there areas within the infrastructure universe that are likely to profit from this?
Yeah, well, I think the big beneficiary in the infrastructure world from COVID-19 is telecommunications infrastructure. People have found during the crisis that, given quarantining and social isolation, working from home generally, that the reliability and speed of their broadband is ever more important. Now, communications infrastructure is essentially the networks and systems that are required for telecommunications to move your data and voice video around the network. And communications infrastructure earns returns basically from telecommunications companies based upon pieces of equipment that's placed in and around their networks. So in the short term, while an increase in demand for mobile telephony and data propagation is not necessarily going to impact the financial returns, the earnings of telecommunications companies, the increased importance of this stuff means that telecommunications infrastructure companies have a long pathway of continued investment in their networks, and that should be broadly supportive for their earnings over the medium to longer term. And we see that in the way that share prices for communications companies have performed in the first 6 months of this year, up more than 20% on average on our analysis. So clearly a very positive fundamental impact on these businesses, and not surprisingly reflected in valuation. These are the big winners.
And so, Gerald, notwithstanding the pretty blunt impact that the virus has had on transport infrastructure, do you see that sector returning to kind of pre-COVID levels?
Well, I think you're going to see different things for different parts of the transport infrastructure world. So transport infrastructure, as we would define it, is really three parts, and that's toll roads, it's railroads, it's airports. So if I deal with airports first, clearly, again, quarantining has meant a collapse in volumes. The volumes are basically zero in most airports. At some point in time, we do expect that to recover. The way it recovers will differ from airport to airport. I think you've got to look at the nature of the underlying passenger base. There's sort of, broadly speaking, three parts of the passenger base. People who are using aviation, who are flying to visit friends and relatives, is the first bit. people who are going on holidays. Leisure travel is the second bit, and the third bit is people using travel for business purposes. And I think we're going to see different recovery patterns out of those three different components. Visiting friends and relatives probably comes back pretty quickly. We think leisure doesn't come too far behind that, but business may be much more delayed. And so as a result of that, we expect that while passengers, you will see a recovery in passengers, it'll be a much more long-dated recovery than what we've seen in the past when demand crises have struck. And indeed, whether or not it actually, while in the long run, we'd expect to get back to pre-COVID-19 levels, we're probably not we don't expect to get back to the same trend line that we were on prior to COVID-19. We see some sort of diminution to that over time. Historically, passenger numbers in aviation have grown very strongly, probably more than 2 times GDP over any reasonable time frame in pretty much any market in the world. And that growth has been a function of two things: growing wealth, people's incomes growing over time, and a reduction in the cost of travel. We expect both of those trends to re-establish themselves in time, and therefore that will be supportive for passenger volumes broadly. But behaviour changes, particularly around business travel, could lead to a diminution in that component. And as I say, therefore, there's some uncertainty about that about the way airport volumes recover over the longer term. So that's airports. We then have toll roads next. Again, quarantining's led to a pretty significant impact on toll roads in the short term. We've seen a more significant impact on cars than we have with trucks. Trucks clearly delivering goods around economies. They've remained a key component of the economy. So trucks down much less than passengers. And already we've seen a pretty significant recovery. So at the height of the crisis, we saw traffic down as much as 80%. Broadly speaking, in markets where they've opened up again, we're seeing toll roads down now at the end of June, around about 20% versus prior year levels. Still down pretty substantially on prior year levels, but a significant recovery from where we're at. And we do expect that over the medium term that traffic numbers will return to pre-COVID-19 levels. Ultimately, traffic is a function of population and economic development in the catchment area. We don't think it may grow a little bit more slowly in the short to medium term, but in the long run, we don't see population as being thrown off its long-term pathway, and economic development we expect, again, while there may be an economic hit in the short term, we don't expect profound changes in the way that the catchment areas have shown their economic development over time. So we do expect toll road traffic to return. Clearly, working from home may become a bigger theme that may lead to some changes in traffic patterns over time, but broadly speaking, we'd be confident that traffic levels will return. And the final one then is railroads. Railroads are very much about the movement of goods across economies. They're a key part of moving goods from producers to communities. The volumes across railroads are very much linked to underlying economic progress, and clearly in a recession that's going to hurt, or a recession or a pandemic, there's going to be a hit to volumes. We've seen railroad volumes in the US down roughly 25% at the height of their crisis. They've certainly made a recovery from those sorts of levels. We would expect continued recovery back to pre-COVID-19-like levels, again, over the medium term. So if I think about the three major components of our transport infrastructure world, certainly some uncertainty around airports, but in the long run, we would expect volumes certainly to return and to get above where they were historically, perhaps not back to the trend line. With toll roads and railroads, we would expect patronage volumes to return to pre-COVID-19 levels in the medium term.
And so when you look at the infrastructure universe, which are the sectors that have kind of proven to be most resilient during the virus, during the crisis, and where do you see the greatest level of value?
Yeah, so as I've touched on already, the big winner has been communications infrastructure, and clearly it's shown to be very resilient through the crisis. Indeed, if anything, you would expect that their financials are going to do better through this period. Not massively better, but better through this period. The other two key components of our universe that have shown resilience are regulated utilities. So pure play regulated electric utilities, transmission and distribution, and also regulated water. Have shown that their businesses are highly resilient. There could well be some bad debt issues in the short term, but generally certainly the regulated utilities that we look to invest in, they're typically in jurisdictions where the regulator allows the regulated utility to recover excessive costs or extraordinary costs over the medium term. So the utilities that we're investing in typically have made the decision quite early on in the COVID-19 crisis that they're looking to support customers, and therefore that they won't turn off electric or gas or water service if customers can't afford to pay those bills. And at the same time, regulators have been very strong in coming to those companies or announcing publicly that they will allow those companies to recover those costs over the medium term, because they're extraordinary costs. So these are business models that have shown themselves to be very much resilient through that process. As to where value lies, that's a different kettle of fish. As I mentioned before, while communications assets are clearly looking at a pretty positive outlook, they've also done very well in the first 6 months of this year, on average up more than sort of 20%. So that's not necessarily the place where we see particular value at this point in time. As I mentioned then, yes, utilities have been very much resilient through the first 6 months. Utility share prices on average are in our analysis are down about 8%. So we do see opportunity in the utility space. And then the other space where we have seen some opportunity is toll roads. Toll road share prices down are on average about 10% on our analysis. Clearly some volume impacts in the short term, and some uncertainty, but we think there are some toll roads that offer opportunity, and we've been looking to participate in that. So if you look at our portfolio, the things that we've been allocating to in the short term, over the last sort of 3 to 6 months, have typically been toll roads and utilities, particularly utilities up to now close on, well, more than 45% of our portfolio, somewhere between 45 and 50% of our portfolio. Toll roads, we've been adding positions to, and it's airports that are down where we see that significant uncertainty.
Thanks, Gerald.
Thanks, Frank.
And thanks for watching this Magellan Infrastructure in Review update. And as always, feel free to forward the link on to clients, friends, colleagues, as you see fit. Please stay safe, and thanks again for watching.